All right, what up? It's Ruben from TGE, and in today's video, I want to talk to you about how do you make money on a call option. All right, you know that moment like when the stock goes up, but you still don't know why you're losing money. Yeah, like welcome to the club. You're not the only one there. so, but in this video, I want to break that down for you so you can actually make money on a call option, and then also discuss about why most people don't make money on a call option. Okay, so before I get into that, let's look at the wins for today. Today we took AMD leaps, and I'm actually going to make an example. I'm going to do an example out of this trade. We took AMD leaps, and I discussed that in the last video, and we made 60% on the leaps. Now, I'm going to leave that as is for now, but I'll come back to this example later in this video so you know how to make, again, money on call options. Okay. Um, All right, let me make sure that because I'm also managing the trades here. All right, so let's say that you find a stock, right? That you like AMD. Actually, let's pull up the AMD chart here. Okay, I'm gonna pull up the AMD chart for you guys. Okay, let's say that you like this stock, AMD, right? And clearly it looks bullish on the daily time frame and everything, right? Let's say you buy a call and then the next day it actually goes up, right? And your option is red. And you're like, why is it red? Right? So there's a couple things about trading options. And the truth is that most traders don't realize this because it's not just about direction, all right? It's about timing, it's about pricing, and just it's not just like you just get into a trade and then see if it should just be profitable if it goes in your direction. A call option is like a bet, all right? So it's not just that the stock will go up, but it needs to go up fast enough and buy enough before the time decay eats it alive, okay? So even if you were right on the direction, you could still lose money if you're too late or too early, or if you pick the wrong strike price, or maybe you also overpay because of like implied volatility or something like that, you know? So let's break this down, all right? So to make money on the option call, you need one, the price to go in your direction, right? It needs to go up. That's number one, and that's just the obvious one, right? But it also has to move quickly, okay? Before expiration. Every contract has an expiration, okay? So every contract, let's write that down. Actually, let's use here. Let's use this scale draw here. So contract details. Contract details have a couple things here. Okay, details. One, you have a strike and you have an expiration. You also have the symbol in the side, right? Now let's just say the side is a call and the symbol is AMD. Now we need to figure out what is the right strike and what is the right expiration. Because if you pick these two incorrectly, and even if the stock goes up in your direction, you're still going to lose money. And you don't want to lose money, right? So let's go back to this chart right here. Okay, so you need one, right? You need to pick a right expiration strike, and it needs to move quickly before the expiration date. You also need to get a good entry price. Okay, so that means that you cannot be overpaying on high implied volatility. If you pay on high implied volatility, you're overpaying, and that's not good. Okay, and you need to pick a strike that's realistic and that's not a lottery ticket. Okay, so that goes back to this: like you cannot mess up the strike, and you cannot mess up the expiration because you will lose money. You will lose. Period. All right. So let's take a look at an example like AMD here. Okay. And Actually, before I get into the example of AMD, I kind of want to show you this chart right here that I made for you. So this is what a call option looks like, right? In theory, if the price goes in your direction, or let's say you get it right here at the money, or you get it right here. If you get that strike and it goes closer and closer at the money in the money, that means that price of the stock is less than the current price. So if you pick a strike that's like 100, and what's the current price? Let's take a look at the current. The current price is 143. Let's say you pick the strike at 140. Let's say you pick 140. The higher the current price is, the deeper, and that's called the moneyness. That's what it's called. Is considered in the money. That's the moneyness. If it's around the 140 area, it's at the money. And if the current price is less than the current strike that you pick for your call option, that's out of the money. All right. So in theory, if price goes higher and higher, your strike goes in the money. In your theoretical value, like how much money you're making, is unlimited. Okay. But to do this, you have to, because not everything goes in one direction, right? Like if you take a look at AMD here, things can go, not everything's one direction, right? It comes down, it goes sideways, it goes up, down, sideways. The market price is random. Okay. So this is where this comes into play. Like, okay, you know what this could be, but we need to also pick this. All right. I want to break down the AMD leap trade here, because I think it's a good example here. I'm gonna put my face in there of how we traded this. Okay. So first thing is first, and I'm gonna actually pull it up here. I'm gonna pull up my tool here so you can see what we're looking at, because this is really important. So we're looking at AMD here. Okay. AMD are the levels that we were looking at, and we said, okay, the first thing that I want to figure out is where are the key levels here for AMD. Okay, so clearly this is one key level. How do I know it's a key level in Gextron? They're just tall bars, whether they're positive or negative bars, right? This is a tall negative bar because it's a little bit more than the unusual. This one is, but also this is a tall bar, this is a tall bar. So these are all key levels, and I want to mark them in my chart. So we go to Trading View, right? And if I go down to the 1 hour time frame, we mark the levels. Okay, great. So let's say that AMD is moving to 140. It's actually almost 145. It's going to 145 right now, and then maybe even 150. Let's say that we bought, actually. I'll use the example that we did. I bought $190 strike. Okay, that is all the way somewhere around here. I'm gonna draw a line here. 190. So how do we make money like this so far out? Well, that means that AMD has to be going in my direction, and that as it gets closer to in the money, I make more money, right? If we go back to this drawing board, even though my my strike is all the way here, I'm still making money as we're going up. And the reason for that is because we got a leap contract. That depends on the expiration date, okay? The expiration date is very important. If you're getting a 190 call, a 190 strike on your option contract in like a week or in 2 days, that expire in 2 days, you're gonna be screwed because you're not gonna win. You're gonna lose money either way. You're gonna lose money, and you're just gonna lose and feel bad and probably like want to stop. Okay, so we got a leap contract. Let me actually take a snapshot of the contract. Okay, I'm gonna show you a couple pictures here. So I'm gonna pull up AMD here. This what we're looking at here is Webull. Okay, that's what we're gonna be looking at here. Webull is an image of Webull. So this is when you're looking at the option contract, at the option chain. Sorry, this is what you're looking at, right? You're looking at a group of expirations. Okay, now There's a couple things I need to do, right? If we go back to these key levels, I need to know where the current levels of resistance are. And I also need to know what my expected move is, right? This is something that I use Gextron for. We just look at further expirations out, and I can see what the expected move is. So I can say, okay, it's got a $16 move, a $20 move. By the end of the year, it has about a $39 move as of right now. So it can go as high as 180. Okay, you can see it right here. There's a top here, a top column. It says 180, and I could just mark that level. Okay. Also, where was the 160? I had a level. I marked 167 because I believe that by September, um, the September quarter was telling me that AMD can move up to 168 for by September. Okay, as of right now. So I mark those levels, and then I say, okay, all I need the stock to do is start moving to my direction. But now you have to figure out, like, well, you need to pick the right strike, right? You need to pick the right strike or the right expiration. I'm sorry, the right expiration, because if you pick something that's too far out of the money, I mean, sorry, too short dated and it's far out of the money, you're going to lose money, right? So you don't want to do that. Okay, so this is an expiration date, and then all I did is because I'm going into Gextron and I'm trying to capture a whole quarter move. Right, we have June, which ends, which is this month, ends very soon, and then we have September quarter. I need to pick an expiration that is really far out, more than a year. That way, I have enough time for this thing to play out the way I want it to. So what I did was I opened up the. I'm going to take a screenshot here. The Which one was this one? I opened up the June 2026 contracts. So I open up, I'm going to take a screenshot here for you guys. Okay, I opened up the June contracts, right? This is June 18th, 2026. I alerted that in the Telegram group right here. I said, this started position 190 June 2026, which was just a couple days ago. So it's June 23rd was when I said that. So in 2 days we made 60% on those leaps. Okay, so if we take a look at this gives me a lot of time, and the delta is very, very high. High delta, oh, right here. High delta means that I'm gonna, for every dollar move that the stock makes, I'm gonna make $38. If you look at a short-term expiration, let's say like it expires in 2 days, you're not gonna make a whole lot of money. That's why we picked out a further expiration. This is a short dated. This is this Friday's, which ends June 27th. Okay, you can see here that we're not even at the 190, and already the delta is very, very low. Okay, it's already low here. This is the delta column right here. So it's already low at 165. Like, we're not going to make any money. And the probability is very low. The way you look at this, delta is like you have 0.01% chance of this expiring to be profitable, right? So you have pretty much a 99% chance that by Friday, this is going to be worthless. Okay. Very low odds. Unlike this leap expiration, which is like 358 days out, I have a 38 probability, and this also has a high delta. So for every dollar move, this will make me $38 per the dollar move. And so the when we traded AMD, we caught it all the way here, pretty much near 129. Okay, it's about 129, and we got it because we like that we were above this key level called P-trans that is found here within Gextron. The levels might have changed ever since then. So it's 138 now. Back then it was 125. P-trans is the first positive tall bar. The first positive tall bar, and everything to the right has to be positive bars. Okay, it doesn't have to be tall or anything. Just first positive bar and everything to the right has to be positive bars. So that's the start of our bullish transition. And at the time, literally 2 days ago, the P trans was at 125. So it was holding this area, and I said, okay, I like this. Let's go for AMD, and I like the quarterly move. Let's aim for that. Doesn't mean we have to hit our target. We just have to have a high enough risk to reward ratio so we can make some good cash out of it. And so that's what ended up happening. Just in 2 days, it literally skyrocketed, and we sold around this level. Okay, making it a 60% return. I believe it was even as high as 65%. But that was it. That was how we make money trading call options. So it's all about, if we go back to this chart, it's just about picking a realistic target using expected move. Okay, let me zoom out a little bit here. Expected move, and you want to also pick an expiration long far enough. Pick long dated expiration. Okay, give yourself enough time. Like if you're aiming for a weekly move, get 2-3 weeks out in expiration so you have enough time for that to play out. Because just like you saw, things go up and down, right? And you don't want to get caught up in all that stuff. If you're picking something that's a month long or 2 quarters long, then pick 8 months to a year out. That way you have enough time for that thing to play out, and you're not getting caught up in like weird intraday economic crap. Okay, because that's gonna make you lose money anyways. So that is how we did it. That's how we traded Tesla and got a 60% return even a year out. Okay, a lot of traders say that you can't make money trading leaps. We just proved it, and we've done this for many years. And so that's it. All right. So again, buying calls isn't just about being optimistic, right? It's about being strategic. Like, what's the catalyst? Will it move big and soon? And like, what's the expected move and what's the implied volatility? All these other things, right? So yeah, that's it. All right. So if you wanna trade with us and you want to learn how to trade more like leap options and just how to pick the right option contract, I'll put a link in the description box. You can come to our private Telegram group and trade with us. And if you have any questions, just put them in the comments below, and I'll get back to you. Peace.